Thanks everyone for joining us for our third session of 5 today. The next speaker we have is Kenneth Andrade, founder and CIO of Old Bridge Capital. As I mentioned to you in my presentation early on, we talked about the strength of India Avenue in the long term is really its partnerships with our advisors who are based on the ground. Kenneth and I have known each other for about 15 years. And Kenneth, when I was with ING based out of India, was one of the advisors to our process then. And Old Bridge Capital is now one of the significant advisors to the India Avenue Fund. So in this session, we've asked Kenneth to, think forward, which is something that comes natural to him in terms of what he expects to be the driving force behind the growth industries of the decade. Kenneth, who set up Old Bridge Capital in 2016, has now got a flourishing business for 5 years, and I introduce him to the virtual podium. Thanks, Kenneth.
Thanks, Vanan. Thanks. Good evening, ladies and gentlemen. It's and thanks for taking the time out to hear us out. A lot's been happening in India, and there are a lot of things that keep us extremely positive despite all the negativism that exists in the system because of the pandemic and the slowing down of the economy. Our positioning and our product is fairly straightforward. We essentially are like a couple of industries that are there, and I will give you an overall sense on how we look at the emerging environment into probably a decade, with a little bit of numbers, just to justify our stance, should I say? But this is what is really happening at corporate India. So I'll just start with where our biases are and what are we doing. We basically have allocated capital into a couple of industries, okay, and these are the couple of business verticals that we'll be essentially looking at. India's created significant capacities in IT, chemicals, and pharmaceuticals, and there's no supply chain that can run in India across the world without these three companies. With these three large verticals, 60% of offshoring of IT takes place in India. You've got generic pharmaceuticals in India is very dominant, and we are fitting into the agrochemical value chain in the chemicals business at a significantly rapid pace. All of this obviously comes because China stopped exporting deflation, and that I think is the big construct that is happening for all emerging markets. So we like to be there. Our belief is that a number of companies in India, a number of industries in India will replicate what the three large businesses in India have done, which is IT, pharmaceuticals, and chemicals, primarily commodity exports, engineering, automotive, farm exports, and a significant number of more of these industries are emerging out of it all. All of this is fairly capital intensive, and one of our best valuation plays, or our biggest opportunities happens to be sitting with utilities. We've got India is a big mix of changing technology and legacy assets. In terms of changing technology, number of companies and number of distribution businesses are now going online, going to exchanges to buy a significant amount of their power requirements on a short-term basis. We've got a simulation of valuations, and we've got a simulation of growth in this portfolio. Utilities have historically grown low single digit in India, but there are opportunities in certain verticals in this industry where, and when I say certain verticals, to put it, it's the exchange, it is the gas utilities, which are growing at almost double-digit numbers out of there. One big change that has happened in the recent time, it's also something that is prevalent across the world, is the top end of the pyramid has gotten an enormous amount of consolidated, enormous amount of wealth. We think that's going to drive it also in India. everything aligned with IT, and IT is seeing massive wage increases apart from quite a significant churn in employee cost, employees, and that's helping urban consumption come right back. Okay, we got a slide on to show you which part of the economy we like within urban consumption. Real estate obviously is one of the biggest, and that's the biggest part of any consumer's balance sheet. And that's the other part of where we are. And finally, the big play, which is on digitization. This year, you will see a significant number of IPOs that will hit the marketplace. All of them are the new age tech businesses. They are intermediation. We are a little slow on that. While we put it up here, we are looking at B2B businesses, and not really the tech-enabled consumer businesses that are currently IPOing. All our companies make a profit. There is not a single company that we have in our entire portfolio that is loss-making. We follow cash flows. And when we say we follow cash flows, we try to anticipate as to where the next large cash flow emergence will be, and we just follow that part of the entire model. So if I just flip over to the next slide, this will give you a sense of our way of thinking and what is physically happening on the ground. Now, in this slide, the right two bars, which are in the box, is something noteworthy to look at. The market capitalization of all the consumer businesses plus the paint businesses. Okay, the consumer business and the paint business is about 16.5 trillion Indian rupees. This 16.5 trillion rupees is back-ended by a profit before tax of 353 billion rupees. Okay, and these are the entire universe, almost the entire universe of, should I say 90% of the universe of all consumer and decorative paint businesses, which is also a consumer business out in India. And if I look at the other end, there's just one company in steel, okay, and India's got about 6 of them. It trades at almost 7% of the market capitalization of that industry, okay, and makes similar profitability. So what we think is happening at the ground level is that the profitability in the Indian environment is already shifted. The market capitalizations have to actually catch up. And that probably for us is a big trade going into the next 4 or 5 years. The slide after this shows us a decadal change in a consumer front-ended business, which is a car company and the steel company, and how this is very apparent as to where the pricing powers. JSW, this is not energy, it's JSW Steel. The EBITDA per ton, okay, it bottomed out somewhere between 2016 and 17, and Maruti's EBITDA per car actually peaked out in approximately 2018. That was the biggest deviation of margins per unit of 2 companies, one at the front end and one at the back end. Okay, and this has completely inversed itself. So obviously, at the front end, the inflation is hurting a lot. The ability of India's largest car company, despite having semiconductor shortages, has not been able to pass on the price hikes to the end user. Okay. And our sense and our belief is, and just going by the previous slide, our belief is that this could be in continuation for a remainder part of the year. Now, this is a valuation. It's a valuation issue, and India's largest steel company, or second largest steel company, which is Tata Steel, trades at about 3 times EV/EBITDA. Okay, on this year, which is Tata Steel, it trades about 3 times EV/EBITDA, and Maruti at same end trades close to about closer to about 20 times EV/EBITDA, and that's what's sitting out there in the marketplace today. Okay, so if I flip over to the other part of the market where we do not exist, or we have very little presence, and what we think will struggle for a little bit of year is consumption growth. And like you've seen through this entire chart, both disposable incomes and private consumption the growth rates have been moderating for a very long period now. What has happened with the crisis or with COVID at this point in time, okay, is households are not just indebted, but they have now started leveraging to maintain their lifestyle. We're going to have a challenge, at least in the near term, both the banking system as well as front-ended consumer companies, in terms of pricing power. I mean, the banking systems will have challenges in terms of how to manage the delinquencies in the system, and this could be prolonged for them. While the consumer companies are going to struggle to, in fact, pass on the price hikes, as the entire middle class and the bottom end of the pyramid continues to downgrade, thereby leaving very little margins or no increase in margins for consumer-facing businesses. Okay, the slide post this, okay, is a little bit of history. It is where credit growths have been, or how credit growths have led the market cycles in India. And 2010 to 2020 has been 2010 to 2020 has been an extreme year where household credit and services credit has grown, which means households have gotten leveraged, and the bottom end, which is industry credit, has or corporates have actually deleveraged their entire balance sheet, which came off the previous year. Okay, when I say it came off the previous decade, and 2000 and in the 2000s, this chart looked exactly the opposite. Household leverage was coming off, and corporate credit was actually increasing. So you had a reversal of the trend. What's happened today, and our takeaways from these numbers are that households are leveraged today. Corporates are under leveraged, which effectively hands over the pricing power to corporate entities, as there's been no expansion of capacity as far as a lot of B2B businesses are out there. When we flip over to urban consumption, this is borrowing rates for India's house for home loans in India, and these are two of the largest companies, the SBI and HDFC, who actually provide housing rates in India. But the next slide is a little more interesting, and where we effectively want to go. If you go back to the commentary of most of the IT businesses, right? The commentary is fairly simple. There's 200 basis points of margin pressures that are happening with companies out there in the international, 200 basis points of margin pressure that's happening out there. And all of that is coming from employee cost. So one of the smaller outsourcing businesses, Cognizant, out in India, has had almost a 30% churn in its employees in the last quarter. Now that's significant, because a significant amount of these these employees are moving for a higher increase in incomes, and this should drive the housing market or the real estate market down in South India. Just to give a sense on these numbers. If I step back about a quarter back, okay, the three largest real estate listed businesses in South India, with the predominance in Bangalore, Chennai, Hyderabad, okay, in these locations, their market capitalizations were lower than the annual salary increases of the top 5 IT businesses in the country. Okay. And there are more than 5 IT companies based down south. So the kind of disposable income that we see coming in from this one industry in a limited geography, which can be leveraged, could keep this market fairly tight over the next couple of years, and it could be a decadal trend for that part or for South India at that point in time. So that's where we basically focus on urban consumption. And when we talk about urban consumption, this is not just the only part of it all. In fact, like it's happened in the rest of the world, restaurants and QSRs have gotten, a lot of QSRs have gotten consolidated, or a lot of restaurants have gotten consolidated. A lot of quick service restaurants have survived, but there are very few in terms of numbers. India's largest aviation company is the only surviving member with that scale in the marketplace today. And should this market open up a little more, there is a number of opportunities to play just the urban middle class in India out there. Okay. So that's a little limited take on urban consumption. I'm sure you have a lot of questions. I'm happy to answer them. And finally, when they talk about India being a very expensive market, yes, India has always been historically an expensive market, but it depends upon what you see and where you see it. Ruchi, if you can just flip to the next slide. Yes. This is a small indication of sometimes how valuations get out of whack. India's diagnostic service market today is close to about $410 billion in terms of turnover. The market capitalization of that industry currently is already over the total potential turnover of India's diagnostic market. Now, now this market capitalization is representative of just about under 10% of companies that have market share in this marketplace. So you've got an industry sitting with a market capitalization of $550 billion, and all of that $550 billion is sitting with companies that just about have a market share of about 8%. So that's where we are as far as looking at a valuation spectrum of India, of corporates in India. You've seen I've taken you through a commodity business and a manufacturing businesses all have valuations which are very similar to what we saw with Tata Steel. You see how consumers are trading compared to what some commodity prices have been trading. You've seen how the pathology space in India, which is a very which after COVID is a very it seems to be a very attractive market because there's growth, there's cash flow, there's no balance sheet, but it's a very crowded marketplace out there. And you've seen the opportunities when we talk about consumption in the real estate space and how incomes are actually getting generated at a significant pace in just one industry. So I leave you with that thought processes. Like we said, that we are a little apprehensive about retail lending, the banking system, and consumers. We tend to believe that they will not have too much of pricing power. But at the other extreme, there is a significant opportunity that everything that's got to do with the B2B business. Obviously, a large part of this opportunity comes because the world's largest manufacturing country that manufactures has stopped exporting deflation. So I leave you with that thought. Happy to take questions.
Kenneth, one question we have got is, are you seeing some of the export-oriented companies getting global export orders as a result of the China +1 theme emerging recently?
Oh yes, I think we've already seen that in pharmaceuticals and chemicals, and now we're seeing it in the automotive space, especially in any business which is linked to metal forming. Okay, why is India very cheap? I mean, the cost of if you go down and look at the opportunity in India's third or the fourth largest country that manufactures steel. Okay, our factory prices or ex-gate prices are somewhere around $800 to $850 per ton. Okay, in Europe and US, it is closer to about $1,200 to $1,400 a ton. So that's the arbitrage that you have in the raw materials itself. And that's a significant advantage that the Indian metal forming businesses and the capital goods businesses or anything that is manufactured using this base has to take it abroad to capture a significant amount of market share. So yes, we're seeing it a lot happening in casting. We're seeing it a lot happening in forgings out here in India. And it's a simple play on arbitrage. It's got nothing to do with the currency. It's got everything to do with the cost.
One more question on that, not on that, but on a separate topic is, obviously India has come out of wave 2 to some degree. and there is the potential for a bit of pent-up demand to arise in the consumption industries. And you mentioned before that you had very little exposure to consumption or financials. Is there a potential that the consumption industry does see, for the next year or two, that release of that pent-up demand and a little bit more credit and leverage boost behind it?
So I'll give you a long-winded answer, but hopefully it'll give you a sense of how the demographics in India actually plays out. India's divided 70% rural, 30% urban. Okay, in 70% rural, and if you look at their consumers and their consumption spends, 60% of their entire consumption spends goes into the food basket. Okay, and 100% of the income is also in some way linked to the food, to agriculture, or to the food, to the income from agriculture, right? It's exactly the opposite of urban India. In urban India, it is 30% of the total income is linked to the food basket. So when we're looking at an inflationary environment, I mean, rural consumption is going to take some time to come back, because every time you have a food inflation scale, which seems to be playing out, rural India has lesser amount of money to spend, or it has a slower growth in net income. That's not so for urban India. So when you look at India and the large population that we have, okay, which is 1.4 billion people, you've got to isolate just about 30% of the population and say this is where the spends are going to take place. And the companies that will participate in those spends, okay, are significantly few, and they will have to be discretionary spends out there. So yes, when the opening trade comes, and when we have the opening trade, and I'll give you a sense, and the way we are actually looking at this business, at this transition, is that the companies that we have on our book, or we've bought into, if they can monetize the next 2 years of this opening trade in terms of cash flows, they will be able to take care of their capex for the next 3, maybe 4 years. So we are looking at the ability of consumer-facing businesses to monetize that significant amount of cash flow that could happen, and this is a one-time exercise that could happen with an opening trade. So you've cleaned up your costs, you've become extremely efficient, and when you exit this pandemic, you will have a year, 2 years of abnormal cash flows, which will fund your growth for the next 3 years, which effectively means that you do not have requirement for external funding. Okay, so so a lot of these businesses will be there in continuity or in longevity, and that's what we tend to look for in terms of allocating capital to these companies. So very clearly, what is emerging, and you take aviation as a business, you take the QSR, which has got the lowest cost there, and you take the real estate market where you're seeing expanding consumer incomes. I think a lot of these will fit in. Of course, the holiday destinations will also come in terms of hotels and leisure travel. So they will also be a part of this entire cycle. So yes, we are a little apprehensive about consumption across the country, but very focused onto a couple of micro markets, or should I say cities, to drive our portfolio.
One more question I have for you is in regards to, you've been managing money in India now for a couple of decades. If you were to put down or attribute one factor to your success, obviously there are lots of factors, but if you were to attribute one thing in particular, would it be more a focus on valuation? Would it be more understanding the cycle? Would it be understanding businesses and management? What do you put it down to?
So when we go through our presentation on how we put a portfolio together, it always looks like we're a top-down and then pick companies from the bottom. But that's not really the case. We effectively try to look for the most efficient business in its industry and keep monitoring that till it's available at a fantastic value. Okay, and once we get that, we just look at an industry around it, and virtually in every cycle, the largest company comes very close to price to book or under price to book. Okay, and that's what attracts us to a business, and then we build up, and then we construct an entire value chain of the entire industry. So when we first put together a portfolio for India Avenues, we had IEX and we had JSW Energy. Right, there are two businesses. One were extremely fixed cost and extremely capital intensive business, and one was very capital light. And actually both played out, but in terms of what IEX did was significantly better than what any other fixed asset on the ground could do. It went on to monetize the exchange, got a higher market share, and is probably sitting at a tipping point where if the industry goes from or if the exchange moves from 6% to 20% in terms of volumes, I mean, it could compound at the pace that it's done in the last 3-4 years since it's been listed. So that's how we construct it. So today we just got IEX out there, or the energy exchange out there, and we don't have any company which has got an extremely large fixed asset base on the ground. And it gives us access to higher market share, and we're looking at pure execution. So it comes in line with valuations, and then valuations have to be fair, and we have to be somewhere close to the bottom or mid-cycle on the way up. We completely try to avoid an industry where every single participant is making money.
One more question which has come in is in regards to China being, working their metal producers hard due to environmental impacts, and this seemed to be benefiting India. Given India's commitment to, the various climate change targets that there are, how do you think India's metal producers will deal with, I suppose the thought process on ESG and, dealing with the environment and what they have to make sure that they comply? So
this is an easy answer, because every single metal producer in India is now started addressing the environment. Unlike the Chinese, and unlike a state-owned enterprise, okay, these companies needed equity to actually go and deliver these compliances. India's largest and second largest steel company, with the next 2 years of profitability, can meet every single compliance guideline, because they've gone through the super cycle of profitability. So it's very similar to what's happening in the Indian discretionary consumer space. Is the kind of capital that you generate, all of that is going back into the entire business to make you extremely compliant. There is just one tagline that all Indian metal producers are talking about, is reducing the net carbon emission, okay, from every incremental ton of steel that is being produced. Every single company is talking about it in the same in the same format. So it's a matter of about two years, wherein and we're seeing this with the Indian aluminum producer, wherein absolute amount of electricity units is down by about 15% on a 2-year basis. So, India's largest private sector aluminum manufacturer, they actually dropped electricity consumption per unit of aluminum. So the advantage that we have is we are fully integrated from iron ore to finished product. The challenges we have is actually meeting environment compliance. Till yesterday, we didn't have the cash flow to do it. exit 2022, all of these companies will have the cash flow to do it, and they are, and they know for their survival and longevity, they have to meet the environmental compliance norms.
Kenneth, thanks very much for joining us today. We really appreciate your time and lots of insights on how you've managed portfolios over the previous cycles as well as the upcoming one. So thanks very much.
Thanks, Govinda. Thank you very much. Thanks.